If you are holding silver right now, physical silver, ETFs, mining stocks, any form, stop what you were doing and listen to me for the next few minutes because something changed. Not gradually, not slowly over years. Something shifted in the market structure, in the regulatory environment, in the way the largest financial institutions in the world are now positioning themselves around this metal. And if you don't understand what changed and why it changes everything for you as a silver holder, you could make the most expensive mistake of your financial life. Not by panicking, not by selling at the wrong moment, but by simply not knowing what is happening above you while you're watching from below. Before I go further, I want to say something directly. If you are serious about understanding the financial system before the crowd does, before the headlines tell everyone what already happened, consider joining our channel membership. 5 tiers built for different levels of engagement. Our Wealth Apprentice, Pal of Swag, Financial Type Banking Insider, Capital Master, Chairman Circle members get exclusive financial insights, behind-the-scenes analysis, early access to select content, and special members-only updates designed specifically to help you stay ahead of the economic shifts most people never see coming. Hit the join button below and become part of the inner circle. Now back to what you need to hear. I spent over 4 decades at the center of global finance. I have watched metals markets get manipulated, suppressed, and then when the pressure becomes unsustainable, violently repriced. And I want to be very precise with that word, violently, not as hyperbole, as a technical description of what happens when a market that has been artificially held down for years through paper contracts, through short selling at institutional scale, through the suppression that benefits the very entities that control the pricing mechanisms. When that pressure finally releases, it doesn't drift higher, it doesn't gently appreciate, it snaps. And right now, the conditions for that snap are more fully formed than at any point in my professional career. Let me be blunt. Silver is the most manipulated major commodity market on earth. I know that's a statement that makes people uncomfortable, especially people inside the system. But the evidence is not circumstantial. It is documented. It has been litigated. Banks have paid billions of dollars in fines for spoofing silver and gold markets, entering fake orders to artificially move prices, then canceling them milliseconds later. Which banks settled? JP Morgan paid. Others followed. These are not allegations. These are admissions backed by federal court judgments. And here's the question you should be asking yourself right now. If the manipulation was real, and courts have confirmed it was, then the prices we saw during those years of suppression were artificial. Meaning the real price, the market clearing price, without that thumb on the scale, was higher than what you were told. Much higher. And what happens when that thumb lifts? But here's what most silver holders don't know. The manipulation didn't just hold the price down. It did something else, something that has created a structural tension in the physical silver market that is now approaching a breaking point. I'll explain exactly what that is in a moment. But first, I need to show you who is actually moving in the silver market right now because it is not who you think. I want you to think about a man named Robert. Robert is 58 years old. He spent 30 years working in manufacturing in Ohio. He watched his pension get restructured. He watched his health benefits get cut. He watched colleagues lose their jobs when the plant downsized. But Robert was disciplined. Robert saved. And 5 years ago, Robert started buying silver. Not because a financial advisor told him to, because Robert, like so many people in the industrial heartland of this country, understood intuitively what paper money means when a government prints it without restraint. He has 400 odd of physical silver in a fireproof safe. In his basement, he is more financially sophisticated than most people sitting in corner offices on Wall Street. And Robert is about to be right in a very big way, but only if he understands the warning I'm giving right now and avoids the traps that are being laid specifically for people like him. Those traps, I'll show you exactly what they look like. Here's the truth nobody wants to hear. There are institutions, large, powerful, well-capitalized institutions that have a direct financial interest in shaking silver holders out of their positions at exactly the wrong moment. They do it through volatility, through orchestrated drops, through news cycles, time to create fear, through social media, narratives that make holding silver feel foolish, outdated, unnecessary. They create the panic, then they buy what you sell, and they have done this before in 1980 and 2011. At every major silver peak, the narrative shifted right before the biggest moves. And retail holders who didn't understand what was happening sold directly into institutional accumulation. I am not going to let that happen to you today without at least giving you the information to make a different choice. The silver market is not what it was in 2002. The structure has fundamentally changed. Industrial demand from solar panel manufacturing has grown by over electric vehicles require silver in their charging systems, their circuit boards, their battery management technology. 5G infrastructure is silver intensive. Military and defense applications are expanding. Medical technology is expanding. Every major technological trend of the next 2 decades runs through silver. And the mines are keeping up. New silver discoveries are at historic lows. The average time from discovery to production for a new silver mine is 12 to 16 years. There is no supply response coming that can meet the demand curve we are facing. And yet, despite all of this, silver is still priced as though it's 2. The question is not whether that changes, the question is when and whether you understand enough to hold through what's coming before it does. Your silver is not just a speculation, it is a hedge against a monetary system that is by every measurable metric under extraordinary strain. Your silver is not a relic, it is one of the most strategically important industrial commodities on the planet. And the people who dismiss it, who mock it, who call it a pet rock, those are the same people who called real estate safe in 2006 and tech stocks can't lose in 1999. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on, subscribe to the Diamond Standard. Here we uncover the hidden truths about silver economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. I'm going to show you the specific trap that has been used to shake out silver holders at every major price move in modern history. I'm going to name it, describe it exactly, and show you how to recognize it when it comes for you because it is already being deployed and most people won't see it until it's too late. The trap, how they shake you out right before the explosion. They have a playbook. It is not written down anywhere public. It is not in any regulatory filing, but it is real, it is systematic, and it has been used against retail investors in the precious metals markets for decades. And if you are holding silver right now, you need to understand every page of it, because if you don't, and I say this without any desire to alarm you beyond what the facts warrant, you will likely sell your silver at the exact moment you should be buying more. I've watched it happen. And I've watched it happen to people who were right about everything, right about inflation, right about debt, right about monetary debasement, right about the fundamentals of the silver market, and they still lost because they couldn't hold through what was engineered to shake them out. Let me show you exactly how it works. Stage 1, a controlled drop. When institutional players want to accumulate silver at low prices, they need retail holders to sell, but retail holders don't sell when prices are rising. They hold and they add. Retail investors buy strength. So to get retail holders to sell, you create weakness, not real weakness rooted in fundamentals, but manufactured weakness through coordinated selling of paper contracts in the futures market. Silver price drops, not because mine supply increased, not because demand fell, but because millions of ounces of paper silver were sold simultaneously in a window designed for maximum price impact. The retail holder looks at their phone, they see red, they feel the anxiety. They remember 2011 when silver went from $49 to $26 in 4 months, and they sell and the institution buys. This is not a conspiracy theory. This is the documented mechanism behind the fines I mentioned earlier. This is what spoofing is, and while the fines were significant, they were rounding error compared to the profits generated by the strategy. But here's what happened next that most people never talk about. After every major engineered drop in silver after 1980, after 2008, after 2011, after 2012 followed, was not a slow grinding recovery. What followed was a move that left every seller behind. Every person who couldn't hold through the manufactured volatility watched from the sidelines as silver did exactly what they bought it to do. It just did it without them on board. And I want to make sure that doesn't happen to you. But first, I need to explain stage 2 of the playbook because the price drop is just the beginning. Stage 2 is the narrative. When the price drops, the media arrives, articles appear, analysts who have never held a physical ounce of silver in their lives write pieces about how silver is losing its luster, how it's been replaced by better alternatives, how the people who hold it are gold bugs, prayers, conspiracy theorists. The language is designed to shame, to isolate, to make the holder feel that smart. Sophisticated modern investors have moved on, and that holding silver is a mark of financial unsophistication. This is social engineering applied to financial markets, and it works not on everyone, but on enough people to move the price. Let me be blunt. The same outlets that told you in 2020 that printing $6 wouldn't cause inflation, the same voices that assured you housing prices would stabilize in 2006, that dot-com valuations were justified in 1999, those are the voices now telling you silver is irrelevant. How did their previous calls work out for the people who listened? I want to tell you about two silver holders in 2011. Both bought silver in 2010 when it was trading around $18 an ounce. Both watched it run to 48. Both were sitting on extraordinary unrealized gains. Then the drop came, engineered or not, and the evidence suggests it was. Silver fell from $48 to $26 in 4 months. The first holder panicked. They'd read the articles, they'd heard the analyst. They felt foolish for having held through the decline. They sold at $28, convinced they'd save themselves from further loss. They locked in a profit, yes, but they exited a position that within the fundamental thesis, the debt, the debasement, the industrial demand was more valid in 2011 than it had been in 2010. The second holder understood the playbook. They held not blindly, but because their thesis hadn't changed, the debt hadn't resolved, the monetary experiment hadn't ended, the industrial demand was still growing. Nothing fundamental had changed except the paper price. That holder is still holding today, and the gap between those two outcomes, measured not just in dollars, but in wealth protection and purchasing power, preservation and financial security over a lifetime, is enormous difference, was not intelligence, it was information. Here is why I'm delivering this warning right now, not 6 months ago, not 6 months from now, because stage 1 is already in motion. The volatility we have seen in the silver market over the last several months, the sharp intraday moves, the sudden drops that reverse just as quickly, the disconnect between the paper price and physical premiums of dealers, these are not random. They are consistent with the pattern of institutional accumulation I have described. In stage 2, the narrative assault is already in the media cycle. I see the articles, I see the commentary designed to make silver holders feel uncertain, outdated, wrong. This changes everything because when I see the playbook running this clearly, this transparently in real time, it tells me one thing with high confidence: something significant is coming on the other side. Here is a simple truth about markets that no amount of manipulation can permanently overcome. Physical supply and physical demand are real. Paper is not. You can sell unlimited paper contracts. You cannot create silver atoms. You cannot print ounces of a metal that must be mined from the earth, refined, transported, and stored. And right now, the physical silver market is in deficit. More silver is being consumed by industry than is being produced by mines. That deficit is not opinion. It is a balance sheet. It is mathematics. It is physics. No paper contract changes that. No media narrative changes that. No coordinated future selling changes the fact that the solar panels being installed this year required silver that came from somewhere, and that somewhere is getting depleted. The question is not whether the physical reality eventually overpowers the paper fiction. The question is only when you're still positioned when it does. Most people will ignore this. They will tell themselves they'll watch a little longer, they'll wait for more clarity, they'll wait until it's obvious, but by the time it's obvious, the move will be half over. By the time CMC is recommending silver, the people who are positioned today will be taking profits from the people who waited for permission. This is not about being contrarian for its own sake. This is about understanding that in financial markets, consensus is the enemy of return. By the time everyone agrees on something, the price already reflects it. Your edge, if you have one, is understanding what the crowd doesn't yet understand. And right now, the crowd doesn't understand what's happening in the silver market, but you do. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on. Subscribe to the Diamond Standard. Here we uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. In part 3, I'm going to show you exactly what the silver market looks like on the other side of this inflection point. I'm going to give you the numbers, not projections, not wishful thinking, but the mathematical consequences of the supply deficit, the monetary tailwinds, and the industrial demand curve colliding at the same moment. And I'm going to show you what the smartest institutional money is doing right now, quietly, without press releases, without announcements. That tells me the window for ordinary investors to position ahead of this move is closing faster than most people realize. Don't stop now, the numbers they don't want you to see. And the window that is closing, let me show you some numbers. Not forecasts, not models built on optimistic assumptions. The actual documented publicly available data that institutional investors use when they build their positions before they ever appear on CNBC to talk about it. Because by the time an institutional investor is talking publicly about a position, two things are true. First, they are already fully positioned. Second, they need retail buying to push the price to where they want to sell. I'm not going to be that voice for you. I'm going to give you the numbers before the thesis is consensus while there's still time to act rather than react. The Silver Institute, which is not a fringe organization, it is the industry's own research body, published data showing the global silver demand exceeded supply by over 184 million Oz in a single recent year. Let me put that in perspective. Total global silver mine production is approximately 800 to 850 million Oz per year. 184 million Oz deficit means the world consumed approximately 22% more silver than it produced from the ground. Where did the extra silver come from? Existing above-ground stockpiles, recycled material, and financial inventories. The silver held in ETF vaults and exchange warehouses that gets drawn down to meet physical demand. And those inventories are not infinite. Above-ground silver stocks have been in structural decline for years. Unlike gold, where above-ground stocks represent decades of supply, silver's above-ground stockpile is measured in months. When that buffer runs thin and industrial buyers cannot source the physical metal they need for their production lines, solar panels, electronics, medical devices, what happens to the price is not subtle, and no one is talking about the real danger hidden inside that deficit number. Because it's not just the size of the deficit, it's what's driving it. The demand that created that deficit was largely driven by solar panel manufacturing. Solar capacity installation globally grew by over 50% in a single year, and the projections from the International Energy Agency, from national energy plans, from corporate investment commitments suggest that pace is accelerating, not slowing. The world has made a commitment to solar energy that is not reversible in any politically meaningful time frame. And every solar panel requires silver. This is not cyclical demand, this is structural. It is baked into energy policy across dozens of countries. It is baked into corporate sustainability commitments. It is baked into infrastructure investment plans worth trillions of dollars. Silver demand from solar alone is projected to more than double within this decade. Against that backdrop, against the supply picture that cannot respond quickly because of the decade-plus lead time on new mine development, the math is not complicated. It's just uncomfortable for people who haven't bought yet. Let me show you one more number that I believe is the most important in the entire precious metals universe right now. The gold to silver ratio for most of recorded human history across civilizations, across monetary systems, across millennia, silver traded at approximately 151 versus gold. Newton codified it into British monetary law in 7. The U.S. Coinage Act of 1792 said it. Ancient Rome operated near that ratio. Today, the ratio stands above 80. That means silver is, by historical standards, the cheapest it has ever been relative to gold. More undervalued relative to its monetary sibling than at almost any point in the last 5,000 years of recorded economic history. Now, I am not telling you the ratio will return to 15 tomorrow. I'm not making a precise prediction. What I am telling you is this. When an asset is trading at the most extreme valuation divergence from its historical norm in living memory and the fundamental conditions, monetary debasement, supply deficit, industrial demand explosion, are all simultaneously creating pressure toward reversion, the risk-reward is extraordinary. If the ratio simply reverts to 40 point, not 15, not 20, but 40, while gold stays flat, silver more than doubles. If gold rises, which every monetary tailwind I've described suggests is likely, and the ratio reverts to 40, silver triples or more from today's price. This is not a dream scenario. This is arithmetic applied to documented market structure. Here's what I want you to pay attention to, not what institutions say, what they do. Over the past 18 months, several of the world's largest sovereign wealth funds have meaningfully increased their allocations to physical precious metals. Central banks, not Western central banks, but the central banks of China, India, Turkey, Poland, Hungary, and others, have been buying gold at record pace. Why does that less C do you matter for silver? Less C because when monetary credibility is in question, when reserves around the world are diversifying away from dollar-denominated assets, the logic that drives them to gold is the same logic that will eventually drive them to silver. Gold has already had its institutional re-rating. The central bank buying of the last 5 years has been a major factor in gold's sustained rise. Silver has not yet had its institutional re-rating. That re-rating, when it comes, and the supply and demand math suggests it must come, will happen into a market where physical availability is already constrained. This changes everything because a re-rating in a market with thin physical supply doesn't produce orderly, gradual price appreciation. It produces the violent repair arc I described at the beginning of this video. I want to speak to you directly, not as a market analyst, not as a banker, as someone who has spent a career watching wealth concentrate in the hands of people who understood something before the majority did, and watching ordinary hardworking people lose wealth because they trust in systems that were not designed with their interest in mind. If you are a silver holder, if you made the decision to own this metal, you were right about something fundamental. You understood that paper currencies depreciate. You understood that real assets matter. You understood that the financial system, for all its sophistication, is built on a foundation that requires continuous confidence to function, and confidence, as we have seen repeatedly, is fragile. The decision you made to hold silver was sound. The question was never whether but when. And I believe, based on the supply deficit, the monetary environment, the industrial demand curve, the gold-silver ratio, and the institutional positioning signals I see, that when is not a distant horizon, it is close. Do not let manufactured volatility shake you out in the final miles of a marathon you have already run. Here is my warning stated plainly. In the weeks and months ahead, you will likely see moments of sharp silver price weakness. These will be accompanied by media narratives designed to make you feel that holding silver is a mistake. There will be voices credentialed, well-dressed, confidently delivered, telling you that the opportunity is past. These moments will feel real. The fear will feel real. And that fear will be the mechanism through which your silver is transferred from your hands to someone else's at the worst possible price, at the most advantageous possible moment for the buyer, and the most costly for the seller. I am asking you not as financial advice, because your individual circumstances matter and you should work with advisors who understand them, but as a human being who has watched this cycle repeat, to understand what that moment is before it arrives. Because the decision to hold or fold is not made wisely in the moment of maximum fear. It is made now in the clarity of preparation. Most people will ignore this. They will keep doing what they've been doing, following the narrative, trusting the sources that have failed them before, waiting for consensus permission to do what the data has already made obvious. And some of you will not. Some of you will take this information seriously. You will research the deficit numbers. You will look at the gold-silver ratio. You will watch the institutional signals. You will prepare yourself emotionally and financially for the volatility that precedes the repricing. And when the repricing comes, and I believe it will come, the gap between those two groups of people will be measured not in percentage points, but in life outcomes, in whether the family has financial security or financial stress, in whether the retirement is funded or frightening, in whether wealth was built or simply witnessed being built by someone else. That is what is at stake. not a trade, not a speculative bet, your financial future. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on. Subscribe to the Diamond Standard. Here we uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. This is the channel for people who are done being the last to know. Subscribe, stay informed, and protect what you've built. Silver holders needed to hear this, now they have. What happens next is up to